Hey traders, and welcome back to IFX. And today we're going to talk about something very interesting. We're going to talk about average trading. How do we do average trading, and how does it actually is going to be a beneficial to a trading system? Okay, so we're going to do some examples of what are the benefits of having a stop loss and not having a stop loss. So with average trading, is pretty much is going to be very simple. It's going to average if we enter on multiple times in the same direction. Then what is that going to do is that we're going to average based on some pip count. Okay, so it's gonna make more sense later when I show you examples, but this is pretty much now. Let's talk about a little bit of what is this minimum distance between trades, because this goes hand in hand with average trading, and how is that going to benefit. So when it comes down to minimum distance between trades, is that what we want to do is that when we set the EA to trade for us, or even if we're trading manually, we want to be able to enter at a distance from one trade from the other trade, right? And this is going in the same direction trade. So for example, I'm just going to show you one example here. If I'm buying over here, right, let's say I'm buying right over here at this point, at this block entry, then if I'm going to buy again, I want to have a distance from my entry, from my first entry to the second entry, of a difference of pips, or by ADR pips, right? So for example, right now at this current, we have ADR of 46 on this current pair on euro dollar. So if we're saying enter between 20 to 30 pips of percentage of these pips, then it's going to enter in between that. So we don't want to enter, let's say, as soon as we get another, let's say we enter right here, and then we get another block like just right over here, right? So the difference from this entry to this entry is not much, let's say maybe 10 pips, just to be rounded off. And we don't want that, because then we're gonna have more risky, well, again, yes, this went in that direction, maybe we would have closed it already, but if we enter again and then have another entry right soon after, then we're risking more over trades, right? We're risking a lot more, because we don't know if it's gonna keep going higher in our direction. So now it goes back negative, and then maybe enters again right over here. So the distance from this trade to this entry from this one is not much. So we want to have a good distance. That way we can actually have better averaging for our trades, and then we don't enter too close together, right? So this is very important when it comes down to the lot sizing that you actually trade. So let's say, for example, you usually trade one standard lot. Maybe it's best to actually split it into different lots, and then you enter once over here. If it goes against you, it's okay, because you're not so strong in your lot sizing. So then the second trade, you say something between maybe 30 pips or maybe 30% of ADR, and then it would enter again right over here. And then from there, what we do is, we can have a better position in the market, right? We don't want to enter just right after the other, like too close together. That's pretty much when it comes down to minimum trades direction, right? Minimum trade entry, minimum distance between trades. So when you set that to true, you have two options. You can choose take pips or ADR percentage pips, right? So in here, if you want to choose to enter in another block in the same direction, it will be 25 pips, or maybe 40% or 30%, so the longer the distance, the better it is for you actually to distance out your trades, right? So we don't want to enter too close together, too close to each other. Sometimes that was happening too often, and I didn't like that. Let's say I was getting an entry, let's say I had set the EA to enter on a first block entry, and then also on a retest, and if you're able to tell where they are within the same price, so I will have two entries just pretty much in the same price, and then what if the market would go against me? So I had two positions open that were at risk, right? So that's not good. We want to be able to have a good distance in between those trades. Okay, so that's very important. Keep that in mind. So that's why I have added this right here, a minimum distance between trades. So you want to have this. This is going to work when you actually set it to let's say you enter on manually and then you set the EA to enter again after that, automatic, then that is going to take into effect. So keep that in mind, okay? Now, right over here, average trading. How does this work? Well, it's very simple. One of the things is you wanna, if you wanna enable it, this is enable lot size multiplier. So if you want to set this to true or false, what does this means? This actually goes together with the minimum distance trade. So if we enter on multiple trades going in the same direction, right? And then, so the first trade is going to be 0.2. And if we set it to 1.3, then the next second trade is going to open at 0.03. And then the third trade is going to open at 0.05, and the next one will be open at 0.07. So it's going to open by multiplying, right? This the lot multiplier by which you actually set it. And this has to be the fixed lot, which is actually has to work on your auto trading. It works in here, auto trading settings. It has to start from either 0.2. It would not work if you set it to 0.1. It's not going to multiply it, or it's not going to add on to your lots, right? So what we want, this could be something risky. You don't have to do it if you don't want to. You can just keep it the same lot sizing. So if you want to keep the same lot size, you just keep it to false. And if you wanted to multiply your lot sizing starting at 0.2, then it's going to keep adding, lot size at different lot sizing pretty much. So here you enter a 0.2, then in here, if your distance is between 30 pips, let's say, then your second entry to buy, this is our first entry to buy, our second entry to buy will be 0.05, for example. Then the other one will be a 0.07. So that means, this is like martingale pretty much, but you're not using double sizing. You're not doubling your lot size, which is very, very dangerous. So don't do that. Only increase it by very tiny lot sizing, which is going to better your trades. And then we're going to go more over later on with examples using this. But that's pretty much with the lot sizing, average lot, with the enable lot sizing percentage multiplier. You can keep it to false if you don't want it to do that. You can actually have multiple trades going in the same direction, but it's not going to multiply your lot sizing. Now, enable average trading. Okay, this is where it comes out when it's necessary if you want to make it true or false. If you make this to true, what does this mean? This means is that if we have multiple trades that open in the same direction, right? After we have set this, open at a distance of 25 pips, maybe we want lot multiplier, you don't want that, it's okay. Then we could say, hey, close the group of trades. Again, this is only working if we enters into a buy, then we're gonna enter into all different buy groups, right? This is goes by group. Buy positions and sell positions, they work separately. Now, you can tell, hey, when you reach to an ADR, we can choose in here ADR percentage pips or regular pips. So if all of them as a group average to 65 pips percentage gain, then the position is going to close. Or if I choose pips, if 40 pips gain as an average of all those trades open, then close all that group. The same thing goes for ADR pips, right? For stop loss. If all of them add up to a specific pip count or ADR percentage pip count, then they're all going to close as a group. Your buy positions as a group first, and then your sell positions as a group as well. Now, hedging. This is important. You can keep this to true if you want to buy and sell at the same time, and then pretty much everything works together as a group, right? Or if you only want this, if you want this as false, what does this mean? What this means is that if the first entry of the day was a buy entry, then all it's going to do is going to enter only buy positions until that group closes. It's not going to enter any sell positions. Or if that on the first day, on the day of trading, if it enters on a sell trade, then it's going to enter only on sell positions until that group actually closes. Okay, so if this is false, you're not allowing buying and selling positions to open during the same day, right? You only want either, if it opens a buy, you're gonna close that buy, and then if it opens a sell and there's no, the buy is closed, then that's it. It's gonna do one at a time. Okay, buy, sell at a time, and sell at a time. Now, so averaging, why is it nice? It's nice because, you know, if the market goes against us, then what we can do is the market is going to now add those as a group, right? So the first trade is going to work as your first TP1 or as your first stop loss. If it hit it, great. If it didn't reach to your first take profit, then after the second trade, then they're all gonna work together as a group. Okay, so that's what you need to keep in mind. So once you have 3 trades together open, buy, sells, then until all of them as a group add up to whatever you said, hey, if it reaches to 65% ADR, then close those trades. So trade number 1 could close at break even or maybe negative. Trade number 2 and trade number 3 could close at positive as a group, and won't, you know, so that way we kind of keeping our losses not too big, and then we kind of minimizing you know, our losses pretty much. That's what we're trying to do. Drawdown can grow big. So this is what's important, is what you want to keep down is your lot sizing. Okay, the lot sizing is very, very important. That's what you want to keep and figure it out. You don't want to oversize your lot size. You don't want to play with that. So I'm going to show you an example. I hope this was clear. If you want averaging, that means is that if the first trade did not hit your take profit, then if a second trade is open up, you know, in the same direction, then they're going to work as a group and then reach a certain percentage pips as a group. Okay, and then that's it. That's pretty much what averaging means. And if you want to set a size multiplier, lot size multiplier, then that means that every second, you know, after the second trade is going to open a little bit higher, third, and so on and so forth. So I have an example here which is really, really interesting, is that I ran over here, I don't know what this is. Okay, so this is a $5,000 account, right? I ran it with the strategy 15-minute entry with the divergence on 15 minutes, and then I also add in the RSI on 1 hour. This is only a 6-month, actually 5 months that I ran really quick. And then this is averaging. Okay, averaging, what does it do? You know, it gave me a drawdown of 3%. I enter with forgot, I think it was 0.05. I didn't do lot multiplier. I did do the averaging, which is 60%. When they all close at 60% of ADR, then close as a group. And then this is pretty much total net profit was $524, and the absolute drawdown was 78. The profit factor was 12, a 30 number of 35 trades, and pretty much all positions of all of it was about 85% winning trade. So that's not bad, right? That's actually quite good. And this is using averaging. Okay, now here's the difference of using stop loss. I use the same strategy, right? I use 40% take, this is no averaging, 40% of take profit of ADR and 20% of stop loss. Pretty much 2 to 1, right? People like that. 2 to 1, that's good. We want 2 to 1 to a trade. If we lose 20%, we want to be able to gain 40%. Okay, nice. And look where this happened. I still had a drawdown of 2.767, which was actually really close to my previous one, which was a what? A 3.4%. Wasn't the difference is absolutely nothing. But guess what? I had a negative of negative $81, while in here I had a profit of $524. So now you tell me, what do you think is best? I know that stop loss can get tricky, but sometimes we kill the edge of our trading. So the main idea in here is that we play with the lot sizing. That's the major factor in here, because when we have $5,000, we want to be able to make money right away. We want to double our money, because we see that on YouTube and so many videos out there where people like double their money within 1 month or 2 months, and you get excited and you want to do the same thing. And what do? Your lot size is like humongous, right? It's like two standard lots for a $5,000 account. And then guess what? You put a tight stop loss on that, and you get so scared when it goes negative, because you're like negative 200 or 500 within like seconds. So you close it and you close it. And again, this happened to me. I mean, it has happened to me hundreds of times, because I was there on that same boat. And I would lose $5,000 within like in 2 weeks, because I would do that. I wanted to double my money right away. So that's like the main important thing. So now let me show you something in here. This is the example of having a stop loss, right? It takes a take profit, then you have multiple trades going to stop loss, then it goes back into profit, and then it plays that game, and that's the game that you keep seeing. Then you have a run of days of multiple trades right here going negative, 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 and then you're like, oh my God, like definitely you don't like to see that, right? You hate that, and then that's when you start again, oh, Forex doesn't work, or this strategy doesn't work, I'm gonna change it up. But guess what? Same strategy right over here, same exact thing, same entry patterns, the same thing, only change was the take profit and the stop loss. Look at the big difference, right? I'm gonna show you something else. Now I went aggressive in here. I was like, you know what? I wanna double my money, right? So on here, I put in a stop loss the same way as before. I just put one standard lot, okay? One standard lot in here. Look, I have a negative 1,300 in here with a drawdown of 45,000. Of course, because why? Because I had a big lot sizing compared to my account. You can only do that with a $100,000 account. Why would you do that with a $5,000 account? So I had a 45% of drawdown and a negative 1,000 in here, 1,300, right? Now check this out. I did the same thing with averaging, right? Guess what? My drawdown was way less compared to the previous one. I actually doubled my money within, well, not in 1 month, but it's still 6 months, whatever, 5 months from here. And I still had a less drawdown compared to the previous example. So now you tell me what works and what doesn't. So this is the same thing. This is one standard lot on a $5,000 account. This is averaging, and this is not averaging. This is doing a 2-to-1. So this is, I'm not telling you to do something like this. Of course, you don't want to double the account right away, because you can still break, blow up your account. I'm not enticing that. But what I'm saying is that, hey, let me go crazy, and still with the same strategy, let me put a stop loss, and then let me get rid of stop loss in here. Let me do the averaging and take a look at the big difference. I was able to double my account. In 6 months, I had a drawdown of 34%, where even with the stop loss, I had a drawdown of 45%. Isn't that crazy? I mean, you explained this to me, because this is just incredible. So pretty much the same strategy. So that's why some people tell me, oh, but wait, my strategy doesn't work. And then I'm like, well, what are you using? I'm like, oh, I'm entering the same as you are. I'm like, okay, do you use stop loss? Yes, I use a stop loss, and I use a big lot sizing, because I want to make I want to make it work. I want money right away. Okay, nice. And I don't enter big lot size, and I don't use a stop loss. So we enter the same way, and you tell me you're losing money. Well, okay, so this is the same thing. This is you, and this could be someone using a different type of strategy with the same type of entries. Okay, I'm not lying to you, this is the same exact thing. This is 15-minute entries using divergence, using the 1 hour RSI. The only difference is take profit and stop loss. That's the only difference. This is why I was telling you in my previous videos that the hardest part is not to enter the market. The hardest part is actually the take profit and the stop loss. This is what freaks us out, okay? And this is what changes the whole world on everybody who's actually consistent and able to make money and someone that is not. Using the same thing, the same tools, different results. So if you have any questions in regards to stop loss or something, I'm going to make a lot more videos in regards to that. Not really had to enter, because as you're able to see, we have the same strategy, but different type of results, okay? This is going, with some, okay, lots, right? And, compared to the other one, we were not even close to doubling the account. But even like that, it was still doable, right? So my question to you is, what are you willing to do, right? What are you going to do? Are you willing to actually try out, do the averaging to see how it works, lower your lot size greatly, and then, just to kind of see how it works. So in here, again, the strategy is that we use a minimum distance between trades. So we don't want to enter too close to each other, right? This is up to you. You don't have to use lot multiplier. You can just leave that the same. We use in here ADR as maybe 65. You can change this around when you're testing out the EA. We don't have not even a stop loss in here. We can do that ourselves, if we actually see that the market is going way against us, right? So the strategy here again was the reversal block entry, 15 minutes with 100 block settings. And again, right over here, let me move. I use the RSI. Actually, it is the 1 hour when I ran it on the tester. It is the 1 hour RSI time frame, 1470.30, and then the divergence, okay, 15 minutes, and then I use the 1226 at 9. And on the take profit, I actually did do the ADR 20%, okay? So I did the 20% and the stop loss is everything is 0, okay? That was what I did on the tester, and those were the results I actually got. So it's very simple. I hope you were able to understand what average U works. Actually, I'm going to show you an example before I go. How does it work, and how does it look like, right? So here it is. We have right here a first entry, right? We have here a first entry, boom, the market didn't meet our first take profit. Then we have a difference of entries, right? Not to enter right away. So when we get another block, it would enter again with the difference of distance. This is the second entry and this is the third entry. And then they close at an average when they all added a 65% ADR. If I would have put 100, maybe the trade would have closed somewhere around here. So this one closed, the first one over here closed at a negative, right? Then this one right here, these two actually closed at a positive. The one that closed the most obviously was the last trade, which was right over here. So yes, when you say, you're like, oh man, I should have left it for longer. Well, that's something that, you could think about it again, and then maybe increase your ADR percentage as a take profit. But that's pretty much what it is. Over here, it entered on a sell, but since it actually met it didn't meet another requirement to re-enter again. So it did meet again the take profit. So, that trade closed. So that was fine with that. It was at a negative for a little bit, but it didn't meet the entry requirement, and that could be the distance of entry, right? Maybe the entry was right over here, so maybe the distance was not met of entry. So maybe it could have entered again. Maybe sometimes when I'm scalping, maybe we can reduce that a little bit, maybe by 30% or 25%. So maybe it will re-enter somewhere in here, and then those two trades would have closed. The second entry would have been here, and then it would close as a group right over here, right? Then we have other examples right here. Again, first entry, it didn't meet our first take profit. Then after the second entry, then they all gonna work as a group, okay? Then when they all meet the requirements of 65% ADR, which he actually just met it, and then after that the market tanked again. So luckily it was able to close. Is this one again? Usually the first trade would close at a either break even or a slightly negative, okay? So that's something that you need to keep in mind. And you know, in here again, this is how it actually works, you know. So in here, this was the first trade, then the second trade met the distance requirement, which is the first criteria, then it entered, and then they both met the criteria for take profit on ADR average, right? And that's it, traded. So I hope this was helpful. I hope the averaging was clear, and I hope now that you're able to see what are the advantages and disadvantages of having a stop loss or not. Again, I'm going to make a lot more videos when it comes down to stop loss. This was just the beginning of it because I have to, you know, let you know, show you an example of what averaging does and how does not work when you actually have a stop loss with it, right? So this is very important when it comes down to the year. This is the new update, so please keep in mind, test it out before you actually do it on, you know, test it out on a demo, test it out on the tester before you actually use it on a real account. So be very careful. This is always up to your, you know, your risk analysis and everything with the market. So if you have any questions, please let me know. Sign up on the Telegram, subscribe to the channel, like the video, and I will see you around.